Okay, listen up, because the rules of the money game are about to change in a big way. A huge new tax law is coming for 2026, and trust me, it's going to affect everything from your retirement and your savings to your actual take-home pay. So, in this explainer, we're going to give you the brand new playbook you need to come out on top.
And I'm not talking about some small tweak here and there. We're looking at a projected $150 billion increase in tax refunds for Americans this year. Yeah, billion with a B. It's all thanks to the new One Big Beautiful Bill Act. That is a massive amount of cash flowing back into people's pockets, and right now we're going to show you exactly how to get your share.
To do that, we've broken this down into a 5-part action plan. We'll start by showing you how to supercharge your retirement savings. Then, we'll explore a brand new way to invest for your kids' future. After that, we're going to uncover some new tax deductions specifically for workers, and then a little extra boost for seniors. By the end of this, you're going to have a crystal clear roadmap for your money in 2026.
All right, first up, let's talk retirement. This is where we're seeing some of the biggest changes in years, and it's absolutely crucial you understand how this is going to affect you. We're talking new contribution limits and some really interesting catch-up rules for older workers.
So, the limits for pretty much all the major retirement accounts are getting a really nice bump. For your 401k, the new limit is $24,500. For your IRA, it's $7,500, and for health savings accounts, it's now $4,400 for individuals and a big $8,750 for families. These new ceilings give you so much more room to grow your savings tax-free or tax-deferred. So maybe you're over 50 and you're feeling like you need to really step on the gas with your retirement savings. Well, you are definitely not alone. And the good news is, the new law has these powerful provisions called catch-up contributions, designed specifically to help you do just that. Let's see how they work.
If you're 50 or older, you can now throw an extra $8,000 into your 401k every single year. And that's on top of that new base limit we just talked about. That brings your total potential contribution to a very hefty $32,500. It's a fantastic way to give your nest egg a serious boost.
But wait, it gets even better. For those of you between the ages of 60 and 63, there's a new provision they're calling the Super Catch-Up. This lets you put away an additional $11,250 a year. This is an incredibly powerful tool for those of you in your peak earning years right before you retire.
So let's just put all that together for a second. You take the new base limit, you add this super catch-up, and you could potentially contribute a grand total of $35,750 to your 401k each year. That is a huge increase, and it can make a massive difference in whether or not you hit your retirement goals.
Now there's one really important catch here that you need to know about. If you're a high earner, making over $150,000 a year, any of these catch-up contributions have to be made to a Roth 401k. So what does that mean? It means you pay taxes on the money now, but then it grows and can be withdrawn completely tax-free in retirement. It's a big strategic shift, so you gotta understand how it's gonna affect your planning. Okay, next up, saving for your kids. The new law introduces a brand new way to save for their future, and it's called the Trump account. We're going to cover everything you need to know, how it works, and how it stacks up against the good old 529 plan.
The Trump account, its formal name is a 530A account, is a new savings tool for kids under 18. It's tax-deferred, which just means you won't pay taxes on the investment gains until the money is actually taken out. And here's the kicker. To get things started, the government is going to deposit $1,000 into the account for every eligible child born between 2025 and 2028.
So how does this new account compare to the classic 529 plan? Well, there are a few really key differences. The Trump account gets you that government seed money and potentially some employer matching funds, but withdrawals are taxed as income. On the other hand, 529 plans don't have that seed money, but withdrawals for qualified education expenses are completely tax-free. And this is important. When you go to apply for financial aid, Trump accounts can count more heavily against you than a parent-owned 529.
So which account should you choose? Well, here's the thing. You don't have to pick just one. Actually, what experts are recommending is a blended strategy. You start by opening a Trump account. That's a no-brainer to get the free government money and any employer match. Then you use a 529 plan for the heavy lifting, the bulk of your education savings, to get those tax-free withdrawals and better financial aid treatment.
All right, let's shift gears and look at some new tax deductions that are aimed squarely at workers. The new law creates two brand new ways to lower your tax bill that'll help you keep more of your hard-earned money. Let's dig into who's eligible and how much you can actually deduct. The first new deduction is for anyone who gets tips. If that's you, you can now deduct up to $25,000 of that tip income. The second one is for overtime pay. You can now deduct the extra premium part you get for those hours. So, for example, if you get paid time and a half, you can deduct the half part of that pay. The great thing is, you can take both of these even if you don't itemize, but just be aware they do have income limits.
All right, finally, let's talk about a new benefit that is specifically for seniors. The new law includes a deduction that could really help older Americans and retirees save a pretty significant amount on their taxes. Let's break down who gets it and what it's worth.
So here it is. If you're 65 or older, you can now claim an additional $6,000 deduction on your taxes. And this is on top of the existing standard deduction, so it's a really direct way to lower your taxable income. But the deduction does start to phase out if your income is over a certain level. That phase out begins at $75,000 for single filers and $150,000 for joint filers, which just means the amount you can claim gets smaller if your income is above those numbers.
Whew, okay. We have covered a ton of new ground, right? From retirement changes to brand new savings accounts and deductions. So let's just take a second to bring it all together and walk through a simple action plan so you can take full advantage of these new tax changes.
Here is your 4-step action plan for 2026. Ready? Number 1, max out those retirement contributions to take advantage of the new higher limits. Number 2, if you have a young child, open a Trump account and go claim that free $1,000 from the government. Number 3, keep careful track of your tips and overtime pay so you can claim every single dollar of those new deductions. And number 4, if you're over 65, do not forget to take that new senior deduction.
Look, this new tax law is a real game changer for your finances. It's a chance to completely rethink your strategy and to rewrite your financial future. These new rules give you the tools to build the life you've been working for. So the only question left is, how are you going to use them? It's time to start making some moves.